Jesus Christ. Hi, hello everyone. It's great, to have Jay with us again. And exceptionally today we're doing it on Wednesday, but it's actually was actually very good, because we had the Fed decision today, and the market action confirmed what Jay said, a couple weeks ago when we last spoke. So, without further ado, I'll hand it to our star. So the first question is, Jay, why don't you explain us what this title has been? So, it's great to be in between. So let's start with that, and then we follow our usual script.
Great. Well, thanks, Roberto, and hello, everyone. Great to be with you again today on a Wednesday, as Roberto mentioned. A little bit different from our usual Monday slot, but in the markets, one has to be flexible, right? So yes, the great in between was the title of the monthly that came out on Friday, and it really refers to something I used to say to my kids when they were younger. We had a country house upstate, and so we would drive most weekends up there and give the kids a little bit of a country feel. And so there was this big part of the drive once we left the city before we got to the real country, which I classified as the first cow. As soon as we saw the first cows, we were in the country, but in between was a long drive. And so I called that the great in between. And it seemed to me, as I was thinking about markets and what I was going to write about, that it was actually a good analogy for where I think we are in the markets, and even more broadly, kind of as a society. When you think about COVID, when you think about climate, when you think about supply chain disruptions, and you think about energy price shocks, we're kind of in the various transitions for all these things. And some of them are obviously going to be with us for a while. COVID is going to be with us. The climate change process clearly going to be with us. Others, I think, are going to be much more short term. If you think about the supply chain concerns, if you think about the energy price shocks, I think those are going to be much more short term. So that's really what I meant by the great in between. It actually builds on the prior monthly, which I titled Transition Time. And so I think we are going through these transitions, and as investors, we need to understand that and position accordingly. And so I'm increasingly of the view that as we move into 2022, it could be a year of clarity, a year of much more kind of traditional market moving action. We'll be coming out of 2 years of COVID fog, as I call it. Climate, of course, is still going to be with us, as I mentioned, but I think it's going to be much more of like a normal year. As you know, I have the view that these easing bottlenecks, supply chain concerns, energy shocks are going to give way to a synchronized global expansion now that we have Asia reopening. And that synchronized global expansion is going to include, in my view, above average growth on a global basis and above trend inflation. And that should be supportive of earnings growth and risk assets. And so that's kind of what I'm kind of iterating towards, is this view of moving beyond COVID front and center, climate still with us, but kind of in the background, the near-term shocks starting to ease, and a year of clarity, a year of more kind of traditional investment thinking, focused on those three transitions that I talked about and have talked about for some months now, that are market transitions. And those are the transition from liquidity-driven markets to earnings-driven markets. I think we're in that process right now. The Fed announced its taper finally today. So we're in that transition. We have a tightening cycle going on globally, led by the emerging market central banks. The second transition is the transition from growth to cyclical value leadership within the equity space. I also think that transition is kind of well underway. If you look, for example, at XLE as an energy play versus XLK, which is the ETF for technology stocks in the US, XLE is outperforming over the last year. So we're underway in this transition of leadership changing from growth to value. And then the third transition is going to continue to manifest is the transition from a bull market in US Treasuries and government bonds generally to a bear market. And I believe that the low we saw in the 10-year US Treasury yield last year of 0.5% will not be seen again for many years. And I expect the 10-year to trade around 2% or better by the middle of next year. And I mentioned that 2% because that is, on a technical basis, that's the level that needs to be breached for the 40-year downtrend in yields to be broken. So that 2% level is very important. Right now, the 1.6, 1.7 level on the 10-year is where there's a lot of overhead resistance because that's what we got to in the spring. And once we break through that, which I think we will as the synchronized expansion becomes more visible, once we break through that, I think we're going to move towards 2%. And that 2% will prove to be, challenging, I think, to break through also. But we will break through it, given that we are going to have above average growth and above trend inflation for 2022.
Oh, this is great, and and that has been. I was going to ask you about one of the transitions is the earnings one, and we basically have the earnings season in the U.S. finished, we're through most of it, and so far so good, and I saw an interesting chart in author's column today on Bloomberg, which is exactly what you said, that what we saw in terms of earnings growth this quarter was enough to take the earnings growth in the S&P back to trend. So it's one of the transitions that you said, which is playing out quite well. So it is in the end of the day earnings is what moves the stocks. And what you also said last time was right, which was was quite a low bar for earnings to be surpassed. So thanks again.
Well, that's an important point because people look at the macro picture and they see the growth slowdown in Q3, which was clearly evident. China, U.S., you name it, growth. Europe was quite strong, but outside of Europe, in China and the U.S., growth was slow in Q3, but yet earnings were robust. And that kind of low growth bar is an easy bar for earnings to beat. And we've seen that yet again, and it brings to mind the point about margins. Everyone's concerned about margins, and that's why I'm arguing that a little bit more inflation is actually a good thing because it provides pricing power for companies and allows them to sustain those margins which support earnings, which, as you 100% correctly noted, earnings drive equities, not GDP growth. If GDP growth drove equities, then China would be the best performing market in the last decade. And it's been far from the best performing market in the last decade. So that's whenever anybody gets confused about growth, GDP growth and earnings growth, I always point them to China, because China's been the dominant growing economy for the last 10 plus years, but the stock market has been anything but a leader over that time period. So
yeah,
yes,
it's a great discussion, and in the same article, he talks about the profit margin. So and of course, the composition of GDP does not mirror the composition in the index, but there was kind of a pattern in the U.S., at least in this century and in the later part of the last century, where profit margins would peak at 10%, then they would collapse with a recession and then go to around 10% again. But now they're at 12%. So I mean, are these things mean reverting, or I mean, should they be at 12%? But then you can add the issue of productivity, right?
Exactly. That's where I would go. And the economy, this is something that we have to continue to understand. And actually, it's a great lead-in to something that I want to make sure we mention. The economy of today, and more importantly, even the economy of tomorrow, does not look like the economy of 10, 20, 30 years ago. This is an important point when people raise, the issue of energy prices spiking. And what is that going to do to the economy? We had a chart in the latest monthly which shows how sharp the decline has been in terms of energy usage per unit of GDP. In other words, we're becoming more and more a service economy in the developed economies. We already know that 70% of GDP consumption, but increasingly, software eating the world, etc. It's not energy intensive growth, and so you can have productivity, and more importantly, it brings to mind something that I introduced in the last monthly, which is we added to our speed lexicon. As you know, highlighted over the last now 18 months, COVID speed, which I introduced in March or April of 2020, right? The combination of intellectual and financial capital focused on a single issue, namely a vaccine, led to multiple effective vaccines developed around the world in 1/10 of the time it has taken historically. This year, back in the spring, I introduced climate speed, right? Climate speed is collapsing the distinction between the long run and the short run. And I just give you the example of what we're looking at today with COP26 and the focus on 2030. 2030 is 9 years away. But in essence, the decisions we're making today, whether it's the Build Back Better plan of President Biden and the focus on climate there, almost a full third or more of this plan is climate specific spending. So 2030 is 10 years away, peak carbon. Net zero is 30 years away, 2050. But we are already dealing with that today. So climate speed collapses the difference, the distinction between short and long run. And this week with the monthly, I introduced the concept of analytical speed. And this refers to the combinatorial, in other words, the combined effect of massively faster and more powerful computation power. Okay? And I basically took this idea from McKinsey. And I actually linked to the article, to the McKinsey article in the monthly, and I highly recommend people take a look at that article, because McKinsey is not a company that says a lot of hyperbole, right? They don't make grand claims. But yet they say in that report that we should expect more progress in this decade than in the last 100 years. Okay, more progress in the next 10 years than in the last 100 years. And this, as an investor, I mean, we have got to pay attention to this, and we have got to understand it, and we've got to position and invest accordingly. And so for me, as an investor, I am focused on shrinking the timeline between idea generation, analysis, and execution portfolio implementation. That's how I'm dealing with it here at TPW Advisory. When we think about our model portfolio setup, when we think about how do we want to position between our global multi-asset model portfolio and our TPW 100% thematic model portfolio. It's all about speed. We have got to understand things are moving faster. And so to kind of put a name to this, I have named it analytical speed. And I think it's something that is truly, we're in uncharted territory as far as how rapidly things are moving. And that obviously has implications across society. Look at the political upheaval that's happening in different places. Look at the issues around COVID, people wanting a vaccine, not wanting a vaccine, climate, etc. So this, I think, is a really big deal. And again, I draw people's attention to the monthly. It's up on the OHM research site. I link to that McKinsey report. More progress in the next 10 years than in the last 100 combined.
And this, also has to do with the issue of earnings growth, because we've talked about this, at least 2 or 3 times, that the market is underestimating the productivity surge that may happen over the next few years. And of course, they're totally linked to what McKinsey say. I mean, I haven't read the report yet, but I mean, am I right to say that this reinforces your point that we're about to see, significant, productivity growth as you said, there is the CapEx boom and there is the acceleration in the adoption of several technologies?
Yeah, I think that's quite feasible. Look, my view on the above average growth and above trend inflation has some short-term characteristics to it and some medium to long-term characteristics. The short-term is the inventory restocking, right? Clearly, if you look, I again have a chart in the month showing rock bottom inventory to sales ratios in the United States. So clearly, when you think about next year, you can be fairly confident about growth because there's going to be a tremendous inventory rebuild. Then you have on top of that the consumer demand, which is going to manifest itself because consumers are wealthier than they've ever been, right? If you look at the US or Europe, you have record stock prices and record home prices. What are the things that people own in their net worth?
Yeah.
Houses and stocks. So there's tremendous consumer power. And then you have the longer term or medium term issues of a CapEx boom, which I expect and I think is already kind of underway. Capital goods orders in the United States are rocketing. We saw that in the most recent PMIs. So a CapEx boom that's going to be driven in part by infrastructure and in part by the need to deal with climate change. And that, I think, is going to have the potential to unleash a productivity surge. And I did write about this. You're correct. We talked about this several months ago when I wrote about it in my monthly, I think now 2 months ago, maybe 3, talking about the analog being the second half of the 1990s, where you had the same thing from 1995 to 1999. You had the last CapEx boom in the United States, and that led to a productivity surge, which allowed for wages to be significantly higher than they had been, wage gains, but yet inflation was kept under control because of the productivity surge. And by the way, the S&P was up 18% on average between 1995 and 1999. And the other point that I'd make here, which I just discovered in the last day or two, is that the number of daily record highs in the S&P is somewhere around 55 or 56, maybe I forget exactly the number, but it's the second most in any single year in the history of the U.S. stock market. What year was the number one year? 1995. So I'm starting to think that the analog is exactly the right one. 2021 equals 1995. And the market is telling us that we are about to see this surge in productivity and in growth. So we're going to have a much higher nominal GDP. We're going to have much higher interest rates over time. And we're going to have higher earnings growth and higher stock prices as a result. And so 2021, with our record highs day after day, is going to set up the same as 1995. I think it's fascinating. You know, history doesn't repeat, but it rhymes.
But it rhymes. Yeah.
I would suggest that people who are interested in this really go back and look at the second half of the 1990s.
No, fantastic, and you know, totally agree. So why don't we now move on to the you know, to the global risk nexus? Then we go, you know, policy climb, you know, as you know, step by step, as you because there's a lot to talk about, you know, especially policy and climate.
Yes, exactly.
Yeah.
Well, yeah, you're absolutely right, Roberto. I mean, I believe firmly, as someone doing global macro, you have to have a process. You have to have a framework. Otherwise, it's very easy to get, you know, distracted by whatever's happening. You know, the latest shiny thing over here or the latest dumpster fire. You need to have a process and a framework. Our framework is quite straightforward. It's the tripolar world, right? That's our first cut. The regional integration in the three main poles of Asia, Europe, and the Americas, which, by the way, day in and day out, and I'll talk about it in a minute, the world is moving towards tripolar regional integration. I feel very strongly about that. The second level down is that global risk nexus you spoke of, which looks at climate, economics, politics, and policy, and finishes up with markets in each of the three regions and globally. And that really allows me to make sure I don't miss anything, or, you know, anything big. I miss a lot, but, you know, anything really big in my analysis. And so, yes, let's start off with climate. Obviously, we have COP26 going on. I think expectations are pretty low. Probably going to meet those expectations. President Xi is not in attendance. President Putin not in attendance in person anyway. President Biden already kind of exiting from Glasgow. And so what I'm looking for here is to really see if we can get a global market for carbon, right? That's really the issue. So far, what has come out is a pledge to reduce methane gases, which is a good step forward, but I think pales in comparison to the importance of getting a global market for carbon. We have to price carbon correctly across as much of the world and as much of the global economy as possible to get carbon levels down. We have to price it properly to get things moving in the right direction. And you know, this is something that I've been very involved in and very invested in with our KRBN position in particular. So that's the first point on climate. The second point is that, remember, there are two main issues, right? There's the power generation. That's where a lot of carbon emissions come from. And then transportation. Those are the two biggest. They account for 80% plus of the world carbon emissions. So I want to make 2 points. On the power generation side, I think very importantly, I'm looking at what happens with nuclear power, and in particular in Europe, if nuclear power is defined as a sustainable energy source in the European taxonomy for climate. And it looks, as we just were talking about before we went live, if you look at URNM, which is our position in uranium, it was the single best performer in our model portfolios this past month, up about 12 or 13%. And that was before today's action, where it was up, I think, 7 or 8%
7%.
on top of that. So clearly, uranium is starting to price the idea that we will have nuclear power as a sustainable energy source in Europe. And I think that could be one of the pluses of the energy price shocks of the last month or two, right? Really reminding people that we need a sustainable baseload power source. And that's what nuclear power can provide. So that's on the power generation side. On the transportation side, obviously, Tesla has made a lot of noise recently. The stock has been absolutely on fire, in large part because of announcements that it's going to be part of Hertz, which is a big rental car company in the US. It's going to be part of the Hertz fleet, as well as Panasonic, the major battery supplier to Tesla, announcing that it's made some significant headway in developing batteries that are going to be smaller, more efficient, in providing a longer range for Tesla cars between charges. And so I would note two things there. One, lit, which is our position for the electric vehicle and electric batteries, was our second best performing position this past month, up again double digits. And so I think that's clearly being expressed in the marketplace. And then very interestingly, Tesla is really becoming kind of like a flagship tripolar world company, because it is starting to dominate not just in the United States, but also in Europe and in Asia. And Tesla was the best performing the best selling model in Europe this past month. The first time a non-European producer was the best selling model, and the first time an electric vehicle was the best selling model. Increasingly driven by climate, driven by supply chain concerns, global production companies are starting to center their production around what is being termed 30, 40, 30. So that's their split of where they want to have production. They want to have 30% in one region, let's call it Europe, 40% in another, let's call it Americas, and 30% in another, let's call it Asia. And that is the tripolar world coming to visible fruition through the corporate production
Bom, gente, só avisando, a conexão do Jay caiu por um minuto, a gente vai voltar logo, estamos restabelecendo o contato com ele. Desculpa o transtorno, a gente está voltando em um segundo.
Can you hear me?
Yep.
I have no idea what just happened. Sorry
No,
about
don't worry. Let's keep going.
Okay. So economics.
The last thing you talked about that, about Tesla and Tesla being the example of the tripolar world.
Right. So yes. So as I was saying, it's really becoming a flagship company with the production process in Europe, Asia, and the Americas. Much as many global production companies are centering their production in each of the three regions on a 30-40-30 split. And this, I think, is increasingly going to be the way global production is done. It's going to be region-centric, not individual country because of pricing issues. So you're going to see increasing amounts of production in Central and Eastern Europe for Europe, in ASEAN for Asia, and in the Americas, South and Central America for the Americas region. And as someone who's been focused on the tripolar world for a decade or more, it's super exciting to see it really manifest itself as we go forward. So LIT and URNM, both great performers. As folks know, climate is the single biggest segment of our TPW20 thematic model portfolio. It's roughly 30% of that portfolio. So two positions there. LIT is one of our single biggest positions, 7% of the portfolio. You can do the math.
Okay, so sorry.
So yeah, why don't we keep going and talk about economics, right? Then we'll do politics, policy, and end up on markets. So in the economics front, it seems that the soft patch for global GDP in Q3 is ending, right? If you look at the PMIs in the last week or so, they've been quite solid, particularly in Asia. As you know, my thesis has been now for several months that Asia is in the process of reopening, and that reopening will start to unclog the supply chains as the Asian factories get back to full production. And we're seeing that. So I'd note that virtually all the ASEAN countries had PMIs above 50 in October. I would note that Japan's composite PMI broke 50 for the first time since April. Yeah. And highlight that Australia's composite broke 50 for the first time since June. So the Asian reopening is in process. The soft patch is ending. And I think the supply concerns are also starting to peak and become less of an issue. And I'd highlight the Bloomberg supply chain indicator, which shows a peaking, and also some commentary from some of the US logistics companies, which are saying that they're through the worst. So this again is kind of the speed issue, which we talked about earlier, the analytical speed. Market folks are talking about supply chain concerns extending through 2022 and maybe into 2023. I think that's just completely wrong. You can't extrapolate in today's day and age. Things are moving too quickly. So easing bottlenecks set the stage for that synchronized expansion, which we talked about at the beginning. Given that we had our little interruption, I don't need to reiterate that. But in essence, I'm of the view that 2022 will be a year of above average growth, above trend inflation. And the way I'm thinking about it is that the trade of 3 to 4% global growth and 2 to 3% inflation is a trade that we should take and be happy about. We don't want to go back to the 2010s when inflation was 1.5 to 2% and growth was 2 to 3%. No, we have the opportunity for higher growth for the restocking, consumer demand, capex boom, productivity surge that I've highlighted several times. And I think we're going to get it. And by the way, this thesis is barely even discussed on Wall Street, let alone embraced by Wall Street. Most people are of the opposite point of view, that we're late cycle, that we're going to have a slowing economy next year. I completely disagree.
No, I agree with you. And I'm totally with you on this. And to add to that, I think that's what the world needs, because with the world, drowning in debt, this is basically the only way to get us out of the problem.
Yes, we can try to grow our way out and have a little bit of inflation, and the combination of the two can address some of the debt issues. I think that's absolutely right. And again, I don't know. I'm of the view that it's not so much the absolute level of debt as it is the servicing of the debt. And we're going to grow well above where interest rates are, and so you're going to naturally chop down that debt as we go forward. So that's kind of where my point of view is. And, that leads us into politics, right? Which is the next part of the global risk nexus. And here I would say that politics, as I wrote in the monthly, is the art of the possible. And the Democratic Party in the US is certainly testing the limits of what is possible with the Build Back Better plan of the Biden administration. And look, I continue to say what I've said for weeks, if not months. It's a question of when, not if, and how much. And I think the when is soon. I think the how much is, the numbers have been bandied about, right? President Biden, before he left for Glasgow, said that we have a framework for 1.75 or 1.85 trillion. And I think that's kind of where we're going to settle out. And we did have some elections last night, yesterday in the U.S., gubernatorial elections.
Virginia and New Jersey, right?
Won. I think that probably should concentrate some minds on the Democratic side to agree, because the Democrats are negotiating with themselves. And it's a big tent party, so you have progressives, centrists, and moderates, and the progressives and moderates are the ones who are arguing. Hopefully they come to some agreement and go forward. So that's kind of my view on the U.S. And then more broadly, we had elections in Japan last weekend, and there the LDP, the ruling party, can maintain its majority, and I expect a pretty big fiscal stimulus to come out of Japan here in the next couple of months. They're talking about something on the order of 4 to 5% of GDP. And then in Germany, we're trying to put the government together, the coalition government. And there too, I expect how Germany deals with issues around its debt break and its desire to, and need really, not even desire, it's a need to invest in infrastructure and digitalization and climate change. How Germany deals with that, I think, is going to be a precursor to how Europe more broadly deals with the same issue. Europe is undertaking a review of its fiscal stability rules, and I think those rules are going to have to be relaxed, if not junked altogether, in order for Europe to be able to meet the needs in terms of infrastructure and climate adjustment. And then, of course, you have the politics in Brazil, which we won't even get into, other than to
Yeah.
say it's problematic for markets, as we've seen. Clearly, Latin America has been a region that is struggling politically as well as market-wise, and sadly, it doesn't look like that's going to change anytime soon. But broadly speaking, I think the issue, the one last issue I want to highlight is in China. And here, I think it's really interesting to contemplate the political environment in the lead and run-up to next year's People's Party Congress, which occurs every 5 years, and in this case is going to address President Xi's desire for kind of an unprecedented third term. And I'm starting to develop the view that this is going to be kind of a glide path year for China, and that all the issues that we've seen China deal with, the edicts on antitrust, on social equality, on tutoring, etc., all those things were done now in 2021 so that 2022 can be a much calmer year. And China has, and this is a pretty good run up to the policy section, China has a full quiver of policy capability, both monetary and fiscal policy, 100% at the ready, hasn't been used in the last year or two in any meaningful way. And I expect next year to be a much smoother year in China, which obviously has big implications for investment and positioning.
Yeah, no, those are two great points. So, I mean, there's a lot that could follow up, but mostly on the U.S., it sounds like you agree that those the loss in Virginia was a wake-up call for the Democrats, because they need to get something done, otherwise they will have nothing to show in 2024. 2022, next year. And in China, what you're saying is that they basically have done the dirty job in 2021. They basically have thrown the kitchen sink into 2021. So I mean, it's going to be all upside in 2022. Because as you said, there are basically two key events in China. One is the Olympics, the other one is the elections, right?
Yes, yeah, no, that's right. Well, and just to touch on the U.S., I think it's important for people to not draw too much from the Virginia elections. I'd make the point that in something like 11 of the last 12 gubernatorial elections, the party out of power has won, out of presidential power, has won the gubernatorial race in Virginia. So this is just as it's always been. So I don't think it speaks very loudly to 2022. I do think it might act as a spur to get the Build Back Better legislation over the finish line. That I do agree with. But I don't think it really signals much in the way of 2022. 2022 is a long way away. This election occurred at the end of a long, drawn-out COVID process in a kind of soft patch for the economy, with lots of, political issues around education and things of that nature. So I just would remind people that 11 of the last 12 elections, the party that was out of presidential power won the gubernatorial race in Virginia. On China, and we have the People's Party Congress, and I think those two are the keys. I do think that though there's not elections per se, President Xi, does need to have people feel good about him. And a lot of the things that he did in the last couple of months in terms of antitrust and social equality are things that were very popular. They may not have been popular to investors, but they were very popular in China. And so I don't think they care that much, right, about investors. I mean, Well, no, I mean, I wouldn't go quite that far. I think they need capital. China needs capital. China needs, capital markets to work for sure. And so I don't think they're agnostic about what happens to financial markets. I do think, though, that we're dealing with antitrust and big tech in the U.S. and in Europe.
Yeah.
We're dealing with social equality issues in Europe and in the United States. China just acts much more directly because it's a much more direct political system. And I think that surprises folks in the US and Europe, where most of the money is, who are used to things like the US legislative process or the EU legislative process, where it takes forever to get anything done. So there's a little bit of that dichotomy. But I think the bigger point is that China, I think, is going to surprise people, and that it's going to be a kind of glide path to next November in the People's Party Congress. And they have all the policy tools necessary to ensure that it's a glide path. And I think that's really the point.
Okay, so we move now to policy now, right?
Policy, yep. And in policy, look, the first point is that COVID, climate, and the energy issues, and even the supply chain concerns are a reminder that we are in an era of big government, right? We've made a significant switch from, less government is good, which has been the ruling thesis in the United States since the 1980s and Ronald Reagan. COVID upended that completely. Climate reinforces that, and things like supply chain concerns and energy price shocks remind people again of the importance of good governance. And so I think, point one is to remember that we are in an environment of big government. Point two would be that policy, switching gears a little bit to kind of market related policy, monetary policy is clearly in a transition, as we touched on at the beginning. We're in a tightening cycle. It's mostly been led to date by the emerging market central banks, but we have had the Bank of New Zealand and the Norwegian central bank raising rates. There's talk of the UK Bank of England raising rates. I think the important point here is that the big four central banks, Fed, ECB, Bank of Japan, People's Bank of China, are going to move very slowly. This is not where the market is. The market is priced in, as we've seen in the last week or two, aggressive moves at the short end. We've had real collapses in yield curves kind of across the developed economies. I think it's been too much, too fast. And we saw a little bit of unwind today where the short end rallied and the long end sold off in the treasury curve. I think we see more of that. I think the Fed is going to want to have space in between ending tapering, which looks like it will be next June, and its first rate hike. The market is priced in a rate hike in July of next year in the US. I think completely wrong. The market is pricing in a rate hike by the ECB next year. I think absolutely completely wrong. So we'll see. But to me, the monetary policy transition is well underway. We're in a tightening environment, but the key is that it's going to be a go slow process, at least for the major central banks. On the fiscal policy side, clearly we have the US with the Build Back Better. We have the next generation spending really taking place. The bulk of the spending in Europe takes place in the next couple of years. We talked about Japan and the new government likely to put in place a fiscal package of 3 to 4% of GDP. Sorry, my light just went out. All sorts of things going on today, Roberto.
Oh yeah,
technology-wise. And then finally, as I pointed out, the Chinese government has a full capacity on the fiscal side. They really haven't used fiscal stimulus at all this year. So, that's the focus on the policy front, both monetary and policy and fiscal kind of underway. And finally, just to finish the point on the monetary side, we have the tapering. Finally, it's been announced, 15 billion per month, starting this month, most likely ending in June. The Fed did seem to give itself a review process in December to assess kind of where things are. But I expect the tapering to continue in the direction that has been laid out today. And as I said just a minute ago, for them to have a period of time in between the end of taper and the first rate hike, possibly one rate hike in 2022 towards the end of the year, maybe a year from now, November of next year. But I think the market pricing of 2 with the first one in July is completely off base.
Mm-hmm. And so great. So to wrap it up, what does all mean for markets? I mean, you were right. I mean, because it's been a great Santa Claus rally that you pointed out. I think on the call before the last one. But I mean, is there anything left?
Yes, I mean, I think there is a fair bit left to go. I mean, we're only in the second or third day, whatever day it is in November. November and December are the 2 best months of the year. I'd highlight that when the S&P is up 20% or more in the first 10 months, November and December combined average 6% gain. The average, irregardless of where the S&P is 3%. So in essence, strength begets more strength as you draw people in and you have the performance chase. And so, yes, I think there's more to come. I mean, if you look at the charts, I just went through all the portfolio holdings earlier today because, as I mentioned, we're in our review process. Things are breaking out pretty much across the board. And I'll highlight that you have ACWI breaking out, you have the S&P breaking out, you have small caps breaking out, you have financials breaking out. EUFN just hit a new 52-week high. XLF is breaking out. The value stocks in the U.S., IUSV, breaking out. I'm watching very carefully to see if the EFA value, which is a big holding for us, breaks out. It hasn't yet. It looks like it potentially is about to. Lit has broken out, which we talked about. The cyber stuff is broken out. So yes, I think this is what people forget. Most of the market has been in a stealth correction for the last 6 months. Most of the market peaked back in February and March. It has done nothing for 6 months. So now we're just now breaking out. So yeah, I think there's plenty more to go. As I said, you just have to look at the charts. The charts look super impressive. So from our perspective, we continue to see commodities as being in a secular bull market across the complex. I continue to feel you can make money as an investor in fossil fuel energy and in clean energy, something I've been writing about and talking about for a year. It's worked absolutely fantastically. I think it continues to work well. I see we continue to like equities. We're significantly overweight equities with a focus on the non-US markets and a focus on cyclicals, value, and small cap, both in the United States. So energy, financials, small cap, and then our thematics, right? The climate stuff we talked about, cyber, crypto, continue to be focused on that, getting increasingly interested on automation and the issues surrounding the lack of labor and concerns about labor shortages. I think that's going to drive automation. So we're focusing in on robotics and things of this nature as well in our thematic space. And as we talked about, continue to be deeply underweight fixed income. And our favorite fixed income market is China. Maybe hard for people to believe, but China is a very compelling, I think, fixed income market. We are taking both Chinese local currency exposure on the government side, as well as dollar-based corporate exposure on the corporate side. So I think there's a lot of opportunity on the debt side in China, as well as on getting more interested on the equity side. I think there's been every reason to sell Chinese equities. We talked about all the edicts and everything. Remember Evergrande in September? Evergrande was going to blow up the whole world. And then we've had all the supply issues and energy issues around coal. Thermal coal prices in China have dropped 50% in 2 weeks. 50% drop in 2 weeks. Gets no attention whatsoever. When they doubled in the space of a couple of weeks, that's all people could talk about for 3 or 4 days. Oh, coal prices doubling in China. Now they've halved. Nobody talks about it. So to me, I think there's been every reason possible to sell China equity exposure. And the point is not that they're going up, but most of the stocks in most of the sectors in China have stopped going down. And that's what has to happen. First, they have to stop going down before they can start going up. So yes, we continue to think performance chase into year end. The bar for earnings is low. I just highlight that Bank of America, they have a forward earnings indicator on a global basis, which is suggesting 20% earnings growth next year. The consensus global earnings growth for next year is only 12%. So I think we're going to have a continuation of what we've had this year, which is earnings beats, and that supports a rising market. And so we remain constructive on equities, very constructive on commodities, and continue to be quite negative on fixed income.
No, this is great, and there's actually a question here on the chat from the floor. I mean, which has to do with what you said on China. Are you somehow worried about this new COVID outbreak, or is just I mean, China having its like zero tolerance, towards COVID, and then they shut down everything?
Yeah, it's a great question, because China is really one of the last countries to maintain this zero COVID approach. Most other countries have not and have vaccinated their people, and so they are not as concerned. China is now in the process, in the challenge for China is that they have vaccinated, I believe, a significant majority of their population, but their vaccine may not be as robust as others that are developed elsewhere. So that's a concern. And they do have the capacity to quickly isolate and lock down breakouts. And that's what seems to be their approach. I imagine they'll continue that up to and perhaps through the Olympics. But I don't think it leads to a significant slowdown or shutdown of the economy. I'd highlight that the service PMI for China, the Caxian service PMI that just came out, was well over 50, I think 53 or 54, and was the strongest service PMI since July. Okay, that was for October. So I do think that China will probably continue to the zero approach, has the ability socially to quickly isolate, and will continue to do so, and has experience in doing so. And if need be, as I mentioned, they have the capacity on the fiscal side, on the monetary side, to address any significant shortfalls. And they have that all overarching thrust of making sure things go smoothly up until the Congress in November of next year.
Yeah, fantastic. So, I mean, that's great. We covered a lot, in 1 hour, even that of the little break, but that's that happens. And, it's great. So, congratulations on the calls. It worked fantastic. And that's just, stay the course, keep calm and carry on. And
yes, exactly. As we did here with our interruption. So Thank you for your patience. Sorry if I think that
No, thank you. It was fantastic,
we got
and
through
I'm
it.
sure everyone is enjoying such great calls. And we'll see each other in 2 weeks or so. The 15th is a holiday in Brazil, so why don't we do on Tuesday the 16th? So
Sure.
so people here are aware. So
Excellent.
thanks a lot, Jay, and we'll speak soon.
Okay, thanks, Roberto, and thanks everyone. Great being with you. Good luck.
Cheers. Have a good rest of the week.
Same to you. Bye-bye.
Bye bye.